What if I told you that tens of thousands of Americans are legally paying 0% on capital gains, 0% on dividends, and only 4% corporate tax, all without leaving the United States? No offshore accounts, no shell companies, no sketchy tax shelters. This is completely legal, IRS approved, and hiding in plain sight. It's called Act 60, and it's happening in Puerto Rico right now. Today, I'm going to break down exactly how this works, who qualifies, what income is actually protected, and the step-by-step process to do it yourself. This is one of the most powerful legal tax strategies available to American citizens, and most people have never heard of it. Stay with me, because by the end of this video, you're going to understand something that most CPAs won't even bring up. Section 1. Why Puerto Rico? Puerto Rico is a U.S. territory, not a foreign country, a U.S. territory. That distinction is everything. Here's why it matters. When American citizens move to a foreign country, the IRS follows them. The United States taxes its citizens on worldwide income, no matter where they live. Move to Portugal, move to Dubai, move to Singapore, the IRS still wants its cut. But Puerto Rico is different. It's a U.S. territory, which means it has a unique relationship with the federal tax code. Congress granted Puerto Rico the authority to set its own tax rates to attract investment to the island, and the Puerto Rican government took full advantage of that. The result is a set of incentives under what's now called Act 60 of 2019, formerly known as Acts 20 and 22, that offers some of the most aggressive legal tax breaks available to American citizens anywhere in the world. We're talking 0% tax on capital gains from assets acquired after you become a bona fide resident, 0% on interest and dividends from Puerto Rican sources, and a 4% flat corporate tax rate for qualifying businesses. This isn't a loophole waiting to be closed. It's written into Puerto Rican law. It's been around since 2012, and it's been upheld and recognized by the IRS. Section 2. The two main incentives under Act 60. Act 60 has two primary chapters that most people take advantage of. Let me walk you through both. Chapter 2. Individual investors. This is the one that gets the most attention, and for good reason. If you become a bona fide resident of Puerto Rico and apply for a decree under Chapter 2, here's what you get. 0% tax on capital gains on assets you acquire after becoming a resident. So if you buy stock, crypto, real estate, or any other capital asset after your move, and it goes up in value, you owe Puerto Rico nothing when you sell. And because of the territorial tax rules, you owe the federal government nothing either. 0%. 0% on interest and dividends earned from Puerto Rican sources after residency. And the exemption on capital gains applies for as long as you maintain your decree and your bona fide residency, which can be renewed indefinitely. Chapter 3. Export Services, formerly Act 20. This one is for business owners. If you run a service-based business that exports its services outside of Puerto Rico, meaning your clients are not in Puerto Rico, you can qualify for a flat 4% corporate tax rate. Compare that to the 21% federal corporate rate plus state taxes most businesses pay on the mainland. 4%. On your entire qualifying business income. We're going to do a deeper dive on the business side in a separate video, but today, we're focusing on the individual investor side. Section 3, the bona fide residency test. This is where people get in trouble. Here's the part that trips people up. You can't just get a P.O. box in San Juan and call yourself a Puerto Rico resident. The IRS has very specific rules about what counts as bona fide residency, and they audit people who try to game this. The IRS uses a 3-part test. You have to pass all 3. Part 1. The presence test. You must be physically present in Puerto Rico for at least 183 days during the tax year. That means more than half the year on the island. Not on paper. Actually, there, physically. Part 2. The tax home test. Your primary place of business or employment must be in Puerto Rico. If you're still working a remote job and your employer is based in New York, that's a problem. Your tax home has to shift to Puerto Rico. Part 3. The Closer Connections Test. This is the IRS's catch-all. They look at where you have closer connections, where your family is, where your social and professional ties are, where you bank, where you vote, where your car is registered, where you go to the doctor. If you spend 183 days in Puerto Rico, but all your real life is still in California, you haven't passed this test. All 3 tests. All 3. The IRS has been very aggressive about auditing people in the Act 60 space, particularly high net worth individuals. They know what this looks like when someone is doing it for real versus when someone is trying to paper it. Do it right, and it's bulletproof. Do it halfway, and you're looking at back taxes, penalties, and interest on everything you thought you were protecting. Section 4. What income qualifies and what doesn't? This is another area where people get confused, so let me be very clear. The capital gains exemption only applies to assets acquired after you become a bona fide resident. If you've been holding Apple stock for 5 years and you move to Puerto Rico, you do not get to sell that stock tax-free. The gains that accrued while you were a mainland resident are still taxable. Only the appreciation that happens after your move is protected. This is actually a smart planning opportunity. Before you move, you might consider harvesting gains on assets you already own, paying the tax now at your current rate, and then repurchasing those assets once you're a resident. Any future gains are then protected. Talk to a CPA who specializes in Act 60 before you do anything. Crypto is one of the biggest reasons people are moving to Puerto Rico right now. If you hold Bitcoin or any other cryptocurrency and you become a Puerto Rico resident before you sell, the gains from that point forward are tax-free. Given where crypto markets have been, we're talking about potentially millions of dollars in tax savings for the right person. What doesn't qualify? Your W-2 income from a U.S. employer is still taxed by the federal government regardless of where you live. Puerto Rico's sourcing rules are based on where work is performed, but the IRS still taxes U.S. source income for U.S. citizens. If you're an employee working remotely for a mainland company, your salary is still taxable. This is why many people pair Act 60 with a business restructure, moving their business to Puerto Rico and becoming self-employed under a Puerto Rico entity. Section 5. The real cost breakdown. Let's talk about what this actually costs, because it's not free. The application fee for an individual investor's decree under Act 60. Chapter 2 is $5,000. That's a one-time application fee to the Puerto Rico Department of Economic Development and Commerce. Once approved, you pay an annual report fee of $500 per year to maintain your decree. You're also required to make an annual charitable donation of $10,000 to Puerto Rican nonprofit organizations. This is a requirement of the decree itself. You must do it every year to stay compliant. Then there's the cost of actually living in Puerto Rico. San Juan is not cheap by Latin American standards, but it is significantly more affordable than major U.S. cities. A one-bedroom apartment in a nice area of San Juan runs roughly $1,200 to $2,000 per month. If you need a larger home or a car, those costs add up. Here's the bottom line on whether this makes sense financially. If your expected capital gains or investment income over the next 5 to 10 years is going to be significant, we're talking $100,000 or more in gains. The tax savings far exceed the cost of relocating. For someone sitting on a large crypto position or about to exercise stock options, the savings can be in the millions. If you're a typical salaried employee with modest investments, it probably doesn't pencil out. This strategy is designed for investors, entrepreneurs, and high earners whose income comes from capital, not wages. Section 6. Step by step, how to actually do it okay. Let's say you've run the numbers and this makes sense for you. Here's the actual process. Step 1. Establish physical residency in Puerto Rico. You need to actually move there. Rent an apartment, get a Puerto Rico driver's license, register your car on the island, open a local bank account. The IRS is going to look at all of this. Step 2. Track your days carefully. From day 1 of residency, you need to be hitting that 183-day threshold. Keep a log, use your calendar, save your boarding passes. If you're audited, you'll need to prove your days. Step 3. Apply for your Act 60 decree. You apply through the Puerto Rico Department of Economic Development and Commerce, known as DDEC. The application is filed online. Processing typically takes 3 to 6 months. You need to have your Puerto Rico address, your financial information, and documentation of your intent to invest. Step 4. File IRS Form 8898. This form is filed with your federal tax return in the year you establish bona fide residency. It officially notifies the IRS that you are now a Puerto Rico resident. Do not skip this step. Step 5. Make your annual $10,000 charitable donation and file your annual report with DDEC each year. Keep documentation of everything. Step 6. Work with a CPA who specializes in Act 60. This is not optional. The rules are complex. The IRS scrutiny is real, and a mistake can cost you everything you were trying to save. There are firms in Puerto Rico that do nothing but Act 60 compliance. Use them. Section 7. Pitfalls and Red Flags. Let me tell you what's gotten people in trouble. Ghost residency. This is when someone rents an apartment in Puerto Rico, gets the decree, but continues living their life on the mainland. They spend a few weeks on the island to hit some minimum threshold they invented in their head. The IRS doesn't care about your apartment. They care about where you actually live. Ghost residency has been prosecuted. People have paid back millions in taxes plus penalties. The 183-day math error. Some people count wrong, or they count days they weren't actually in Puerto Rico. The IRS can pull passport records, flight manifests, credit card transactions. If you say you were in Puerto Rico for 200 days, and your credit card shows you buying groceries in Miami every other week, that's a problem. Not restructuring pre-existing assets. As I mentioned, gains on assets you owned before moving are still taxable. Selling those assets after your move and pretending the gains are Puerto Rican sourced is tax fraud. Moving and then leaving. If you establish your decree and then move back to the mainland within the first 3 years, you will owe back taxes on the gains you thought were protected. There's a built-in holding period to prevent people from using this as a temporary tax dodge. Section 8. Is this right for you? Let me give you a simple framework. This strategy makes sense if you have significant capital gains, income coming, crypto, stocks, real estate proceeds, business sale. You're self-employed or own a business you can restructure to Puerto Rico. You're willing to actually live there for more than half the year, and you have the budget to do this right. The fees, the CPA, the move itself. This strategy probably doesn't make sense if your primary income is a W-2 from a U.S. employer. Your expected gains over the next decade are under $100,000. Or you're not willing to actually commit to Puerto Rico as your primary home. The people who benefit most from Act 60 are investors, entrepreneurs, crypto holders, and anyone who's about to experience a large liquidity event, a business sale, a startup exit, a large stock option exercise. Outro Puerto Rico is not a loophole. It's a deliberate economic incentive program designed to attract investment and talent to the island. And for the right person, it's one of the most powerful legal tax strategies available under U.S. law. If this video gave you a new way to think about your tax strategy, hit that like button It helps more people find this kind of content. And subscribe if you want more videos like this. We cover the tax moves, investment strategies, and financial tools that actually move the needle. In our next video, we're covering the business owner side of this, how companies are restructuring under Act 60, Chapter 3, and paying 4% corporate tax instead of 40%. If you run a service business, that one is essential viewing. As always, this is not financial advice. Always do your own research and consult with a qualified tax professional before making any major financial decisions. I'll see you in the next one.